Hi, I'm Shaun Ferrugia.
And I'm David Makovsky.
We're from Optimised Accounting, and this is a budget wrap-up for us. There's definitely a lot more to go through today than there has been in previous years. There's not a lot left untouched. Anything that was rumoured happened in some way, shape or form. There's quite a bit to go through and definitely some planning involved. David, where should we start with this?
There's a lot to unpack here. It's a lot of the planning that we've put in place for clients over the last few years is being directly unwound by some of these proposals. So of course, these are just proposals at the moment and legislation has to come into play before we can start seeing what the actual details are and working on tailored plans to get unstuck from some of these proposals. But to cover off on some of the announcements, the biggest one off the bat is definitely CGT.
The changes to CGT are happening from the 1st of July 2027. One of the biggest changes that was announced in the budget is the changes to the capital gains system. This has been widely reported in the media over the last few months, and it definitely did come into effect. We don't have all the details yet because it's obviously subject to what's in the legislation, but what was announced last night is that from 1 July 2027, there's going to be a minimum tax of 30% on capital gains and an abolition of the CGT discount. So the CGT discount is the halving of capital gains before they are taxed. So that means that at the moment, the effective rate of tax at the maximum level is 23.5%. So the minimum 30 is actually going to apply from the first dollar. So this isn't good news. But if I've got an asset that I hold now, David, and I sell it after 30 June, what's going to happen with that?
So let's say you bought this asset for $1 million 5 years ago.
Yep.
And in 5 years' time, you sell it for $2 million.
Yep.
What's going to happen is your capital gains are going to be split in half. And on that first half, up until the 1st of July 2027, you're going to get the capital gains discount. And then beyond that, the second half of the gain, you're going to be taxed based on an inflation approach. So your gain's going to be indexed based on inflation, based on CPI from the 1st of July 2027. And under most modelling we've done so far, it results in you paying a much higher level of tax.
Yeah, it sounds almost good news that there is that grandfathering involved, that the asset is safe, but the loss of the discount afterwards and then that minimum approach seems to make up for quite a bit of it. One of the biggest surprises with this, though, was what's happening to pre-CGT assets. So assets that were bought before capital gains started in 85. What's the story there?
And so this was a quick one-liner on budget night, where normally they sit outside of the capital gains system. You end up getting those gains tax-free, which if you've bought property before CGT come into play, they're usually massive, massive unrealised gains. So what's going to happen here is they've said that from 1st of July 2027, you'll still retain all of that tax-free element on your unrealised capital gain. They haven't given too much detail what happens beyond that, but they didn't say that it's not exempt. So we're assuming it's going to be taxable, and there may be some planning opportunities that come in there.
Yeah, it's taxable almost, just reading the theme of the budget's almost inevitable with that one. What I found interesting there, and there's plenty of business here for valuers by the look of it, because not only can it be a proportionate approach, I think that it could be used with some of the capital gains, but there's a valuation approach that can happen as well. So
yes,
yeah,
definitely.
If you've got those pre-CGT assets, you'd really want to be getting valuation, hopefully at 30 June, so at least the cost base at that point is a decent reset point.
Yeah.
Yeah. Was there anything actually exempted from the capital gain changes?
There were new builds.
They'll still be eligible for the discount. How about if I sell my house? Is there any changes to that?
The main resident exemption still stays in play. So if you've only lived in your house and you haven't rented it out, you still get the main residence exemption, so no capital gains there.
And what about the all-important small business CGT discounts and exemptions?
At the moment, no changes to the small business CGT concessions. Still in play. Although, while they haven't changed how those rules are made up, because of the lack or because of the disappearance of the capital gains discount, some of those thresholds that were normally pretty generous under the small business capital gains discount can be haircut, or at least filled up quicker if you're looking at a large gain from selling your business.
So that'll mean 15-year exemption still could be in play, but if you've got the active 50 and you were doing it with a CGT discount, it gets axed.
Yep, as well as using up retirement limits, having to put more into super on lockup from the sale of a business.
And this definitely isn't something that we rehearsed before, David, so you're on the fly with this one. Does that mean all businesses need to really get a valuation at 30 June 2027?
And again, we'll wait for the legislation. At least a bit of an idea of what your business is worth at that point in time, because that's going to lead directly into what actions you should take, if any.
I'm glad that we don't do valuations internally, but we do work with some trusted and very reputable valuers. And yeah, how you do a retrospective valuation on a business is best left to those experts. So apart from the CGT changes, and look, I don't know why we're laughing at it. It's really not because it's funny, but I'm just trying not to cry, really.
You have to laugh through the pain.
The negative gearing changes, though, this is an interesting one too. So this one, though, will only impact residential properties. You can still, if you hold commercial properties or if you hold shares or anything that are negatively geared, no worries. Negative gearing still does apply to those. What it won't apply to anymore is from 1 July 2027, it will not apply to any, you will not be able to apply the negative gearing to any of your other income. So what that means is if it's used in the traditional sense where you're offsetting your salary and wage income or your investment, your business income, that's no longer going to be allowed. What will happen is you can offset other properties' income. So if you're in a fortunate position where you've got a lot of positively geared properties already, you can definitely take a portfolio approach and negative gear a property that you buy anywhere between now and 30 June 2027, and you'd be grandfathered into those provisions. Yeah, on that one, I find that one really weird that you can take a portfolio approach. How's that supposed to improve housing affordability?
Well, if I own 15 properties that are all fully paid off and they're cash flowing and very positively geared, I can go out now and pick up a couple more properties and have those negatively geared and get the tax savings and still offset those against my positively geared properties that I've already got.
But if I don't have a property and I decide to buy a property today...
Yeah, it's not for you. This measure's not for you.
So if I'm maybe a rent investor, the first home buyer that says I'm going to want to just do the rent vest strategy to get into the market, I'll be able to, if I buy a property right now and it's not brand new, I can negative gear till 30 June next year, get a little bit of a tax saving.
Yep.
And then after that, not for me.
Not for you.
Because I didn't buy the 15 properties earlier.
You should have bought 15 properties and paid them all off years back.
Damn, that's, definitely who the Labor Party was hoping to help there, right. The crux there is you can definitely offset the negative gearing with residential properties that you have already at the moment till 30 June 2027. After that, it stops unless you've got a new build. However, if you do have other properties that are positive geared, the grandfathering date, which was 7:30 p.m. yesterday, doesn't really apply to you. So you can really go find some more negative geared properties, new or not, up to 30 June next year, and you'd be able to continue on negative gearing them. So that's not necessarily bad for people who are in that situation, but for the majority of the population, not really good news. This is really designed to stoke investing in new builds. So this is where I guess the government's aim here is to increase the housing supply. The aim is to align the negative gearing aspects to that. And as David said, they're also on the back end, when you sell a new property, you'd still have access to that CGT discount. The definition here of a new property is if you're buying vacant land and building it, or if you're doing a knockdown and building more dwellings on the property. So if you knock down a single dwelling and build two, that's okay. But if it's a knockdown rebuild 1-for-1, then that won't count either. So it's designed to increase housing supply. But yeah, it's definitely a big change. And it was worth also keeping in mind, I think I said it earlier, commercial property shares not included in this. So you can still negative gear those options. Now the big one, this one I think is going to be a big amount of review and planning and restructure with almost everyone that's going to be watching this as part of our client base. Family trusts.
The classic family trusts are being absolutely hammered as part of this budget. So I think federal budget numbers come out and say that there was 350,000 small businesses in Australia that operate as family trusts or have a family trust in the mix. And I know 99% of our clients are either have their business through a family trust or their business company is held by a family trust. This is going to impact almost everyone.
That's 210 family trusts I looked up.
So from the 1st of July 2028, family trusts will pay 30% minimum tax on distributions flowing into it. So this is also a non-refundable offset. So it doesn't work the same way that franking credits work with companies. This is a flat tax that's out the door. So from 1st of July 2028, any income flowing through a family trust needs to be carefully planned for, because it will get hit with a 30% tax that the trustee is liable to pay.
So that's a big change. So at the moment, trusts technically don't pay any income tax. Obviously, they'll pay their BAS, but there's no tax bill in a trust. So what we're saying here is what the trust is going to have a bill of 30% of the profit,
Correct.
get into PAYG installments in future.
Yep.
And then when I do my tax return as a beneficiary, as an individual, I'll get that 30% as a credit.
You'll get it as an offset, but it can't be refunded. So under a classic example, if you've got mum and dad operating the business through a family trust, earning about $100,000 a year, if we're distributing 50-50, so 50,000 a mum, 50,000 to dad, each of them will pay around about $6,500 in tax. So all up, their tax bill for the year would be 13 grand. Dad gets a bill for 6.5, mum gets a bill for 6.5. Under the proposed changes here, what would happen there is the family trust would pay tax at 30% on 100 grand, being $30,000, more than double of what the 13,000 total tax bill would be currently. And then mum and dad complete their return and they have no additional tax to pay on those distributions, but they don't get a refund for the overage compared to what they paid under the old rules either. Their tax bill has now more than doubled.
That's insane. So going from a 12% effective tax rate in that scenario there to, and then if I decided to sell as well some of my, let's say I had 10 grand of Telstra shares and I wanted to sell those at the same time, you're telling me there I'd have to pay another 30% minimum tax on that gain.
Correct.
Even though my minimum tax rate or my average tax rate's nowhere near that figure.
Yep, that's correct, because now the minimum tax rate for capital gains has been uplifted to 30% as well.
It's insanity. It's
A
insanity.
lot more tax.
But it gets worse. So the bucket company strategy, this is the part that I am very, very keen to see the legislation on. So as part of that, how a bucket company works in with trusts, just to actually go back to David's scenario there, where the break even and tipping point was around what, 190,000?
190,000.
So if you've got a trust and you've got distributions to beneficiaries and you're on the lower end of the income threshold, once you're the standard mum and dad business, you might be distributing a couple of $100,000 a year. If you got that, maybe less than 200,000 profit, you distribute it, it's actually a tax increase for you.
Correct.
But if your business makes $400,000 a year, it's about break even.
Yeah.
But if you're earning more than 400,000 a year and you have to put a bucket company in, this is where the devil in the detail is going to come in.
Yeah.
So what happens with that 30% minimum tax if I distribute to my company, David?
There's no benefit to the company. So unlike the individuals where they got the offset of the 30% that the family trust has previously paid, a company doesn't. So the bucket company does not get this offset passed along. Bucket companies are generally taxed at 30%. So you're now looking at an additional 30% tax to your bucket company on top of the 30% that your family trust has already paid. We're talking about potentially 60% tax.
Depending on how it's calculated, 52 to 60% where it could be. And at the moment, you'd have a bucket company, you've got the tax paid to franking credit. That 30% tax that the trust goes in is not a credit anywhere else. The company tax that you'd pay within the company is refundable, but then if it's going back through a trust, that's going to get eaten up there. So there's definitely going to be a lot of restructuring and planning around bucket companies once the final legislation is out and we know where the chips all do fall. So it wasn't really spoken to quite a bit, but it's definitely the one that's going to be the heaviest hitting, I think, out of all of these. The restructuring options, though, the government has announced that they are going to put some restructuring concessions in for 3 years from 1st of July 2027. So this is obviously designed to move people out of family trusts. Once we see what those concessions look like.
There's absolutely no detail at the
There's
moment.
no
on
detail.
those.
The parts that have been discussed already exist anyway in some way, shape or form.
Yeah.
So I don't know what the extra concession is. I assume that there will be some, there has to be some, they've announced it. But the interesting part there is it's going to be weighing up those concessions, and also how does that affect the 15-year rule for small business concessions? There might be times where it's actually not worth doing that, especially if we're going to reset a timer. Yeah. That's really going to be played in. So there's going to be a lot of moving parts with this between business structure, family dynamic, income levels, succession, asset protection, all those different things that go into a structuring decision really need to be just revisited based on these new rules once we know what will go through.
And it goes beyond federal taxes, but also there are some states where as part of business restructures and moving assets around, you're going to trigger stamp duty. So that's an additional tax on everything else that we're talking about. So we're hoping there that these measures extend to state governments as well and to put measures in place to exempt.
We're hoping. We're optimistic. I don't see that happening. Yeah, I guess the issue there is if you've got a property though in a trust that you're trying to transfer as well, it's likely to be hit. I don't see there's going to be any new concessions. There's already some concessions around restructuring there, but I don't think that they'll be broadened, but we can hope.
Yeah, they're very narrow.
On to some smaller items. So the instant asset write-off, that's one that's been in for the last forever in some way, shape or form, but it's always will they, won't they extend it. What was the good news there last night?
Finally made it permanent. Instant asset write-offs permanent at 20K threshold, which means you're purchasing an individual asset below 20K, you get the immediate depreciation on it in the same year that you've purchased it.
Then there was the loss carryback measure. So that was one come up during COVID and then disappeared.
So now what the proposal is that if you've paid tax in the last 2 years, you make a loss in the third year, you're able to offset that loss and actually refund some of last year or 2 years ago's tax bill that you've paid.
Yep. And I assume that's if you haven't franked it out as a dividend or something, that there'll be some concessions there, but we'll see the legislation. Then there, for employees, there's the $1,000 deduction from 1st of July 2027.
And it's not a $1,000 refund, it's a deduction that leads to a percentage of a refund.
You're telling me I'm not going to get $1,000 back?
You're not getting $1,000 back.
What? It just goes off my taxable income. So I could get $300 back or something based on that.
Around about 300 on average.
Yeah. And then there was
the 250.
That's right. Yep.
If you're earning your income through wages or as a sole trader, then essentially your tax-free threshold creeps up a bit to the benefit of $250.
Yeah, so that's, increases the threshold. There's no means testing anything on that. It's just if you've got a salary income or small business income, you get that $250 rebate.
Whether you're earning 30 grand or $2 million, you get $250.
There was a bit of a sneaky cut there to the private health rebate. At the moment, if you've got private health cover and you're receiving the maximum sort of rebate, you're getting maybe 26 to 30% off your private health cover. If you're a retiree and you're over 65 or 70, at the moment, those rebates actually do creep up with age. And now, from 1st of July 2027, those rebates are not going to be age-based anymore, and the additional rebate that the retirees have been getting will go back to the base level. So what we're seeing here is when people are older, more likely to need healthcare, decide to take up private health to ease the public system, they're going to get penalised for doing that and potentially be pushing people back to the public waiting lists, especially if they're not needing the private health tax purposes because they're retired.
It's an interesting measure to say the least.
Was not expecting that one. Look, there's a slight amount of good news for new businesses that's coming in as well, which is a loss refunding. It's a very narrow who it's going to apply to, and the detail on this is very sparse at the moment, so we'll see what comes out. But the idea is that if you've got a new business, was it over
within your first 2 years and you're turning over less than 10 mil and you're making a loss, and you can claim that loss back as an actual refund, only capped to the extent of the tax that you've paid on your employees' wages, as well as any fringe benefits tax paid.
Yeah. For most small businesses there, if you've got a company, you're paying yourself a wage, you don't have to worry about pushing your company into a loss and then paying tax personally to offset that.
Correct, yeah.
In other situations, it might be a bit of limited use, but I guess once the detail's out, we'll figure out the best ways to implement that strategy. That were the main items in this year's budget. It's like someone's pulled the tablecloth from under it and everything's flown everywhere. But there's a lot of planning and restructure work that's going to need to be looked at with this. At this stage, the legislation's still under embargo. It hasn't been released. We've got no idea of what the detail is actually going to be on this. Once it is released, it still needs to go through and be debated, and we'll see. Will it all come to light? Maybe there'll be opposition. I don't know how strong the opposition will be in opposing it, but we'll see what happens. But until that legislation is out, there's not much that can be done. But as soon as there is clarity around it, we'll definitely be organising and reaching out to all of our business groups and just ensuring that we give you some options there for doing some restructuring consults and figuring out the best way to structure the business going forward to make sure that your position is both legal but also optimised to achieve all of your goals. And that includes not just the tax side of it, but for asset protection, structure, family dynamics, all those things are taken into account. That's it for now. You'll see, if you haven't received it already, an email from us with a guide that has the budget items in some deeper measures. If there is additional information that you do want, please reach out to us and we'd be happy to record some more content based on this and go through any questions that are answered at the moment. But at this stage, yeah, it's a bit too early to be able to work out exactly what it will be for individual circumstances. There's just not enough detail there.
Yeah, and once we do get legislation, hopefully sooner rather than later, we go through it with a fine-tooth comb and look at how it applies to all of you individually.
Thank you for your time. Enjoy the day. Cheers.